Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts Chat for January 12th of 2025. Well, I say we start off the chart pack this week with the big news that was reported last week coming out of the labor market. We've got a few slides on labor to kind of bring us up to speed. Last month, you can see here the non-farm payroll number. We got 256,000 jobs in the month of December. So this data comes basically is reported at a lag of about a week after the end of the calendar month. And you can see over the last couple of months, we've had a notable rise. And so, I would say that definitely this is much more. This is about 100,000 jobs more than the market was expecting. And so it turned out to be a big surprise. Ordinarily, you think this is a really, really good thing, but what it did was it took the expectation of Fed rate cuts really down to almost zero, not quite zero, but expectation heading into this year was that we're going to get two more rate cuts sometime here in the first half of the year. And with a really strong labor market like this, and you've got 2.23 million jobs created over the last year. And again, this number, over 100,000 jobs more than was expected. And so it was it was a positive surprise from a data standpoint, but negative shock to the market that was really betting on those rate decreases. And so as a result, we had the 10-year Treasury, which closed up at about almost 4.8%. That was its highest level in more than a year. And the one thing in these charts that I don't have is the average hourly earnings. Basically the wage data. Wage growth continued to moderate. Average hourly earnings were up about 0.3% from November to about $35.69. That was in line with expectations, but it was actually a little bit lower than the prior month. So I think that really confirms that, the feeling that the labor market isn't really the primary source of any type of lingering inflation at this point, even though those wages may be a little sticky a little bit. But on this number two, before we leave this page, it's important to note that this is more than twice the number of jobs that were expected to be generated in 2024 when we were at this juncture last year. So labor market has shown an awful lot of resiliency, and I would argue, and we'll look at this in the next slide, that we're kind of at an equilibrium point. So here we have the unemployment rate, 4.1, ticked down slightly. You can see that there's a lot of staying power here at this 4% level. And then coming off of higher levels of unemployment, kind of coming out of that peak pandemic period. But I think that the prospects of seeing a large spike in unemployment, barring a recession of some sort, is probably unlikely. I mean, we see a lot of data, and I don't have these charts for you, but the Challenger Gray numbers have really been fairly steady. You look at it over kind of a moving 12-month average. It's really been kind of static lately. Now, we get a little bit more optimism from small businesses in terms of hiring. Be very interesting to see what the regional Fed surveys are going to look like over the next several months with regard to labor. But I think all signs point to a stable labor market with wage inflation that is just gradually coming off its peak. It's being very stubborn, but at the same time, what it is doing is it is providing more wherewithal for consumers to spend. Here we have jobless claims. We get this on a weekly basis. You can see that this drop here heading out of the holiday season is rather notable. Again, this data goes back to beginning of 2022, and you don't necessarily see these types of things, nearly as pronounced as we saw this. So jobless claims going way down. Again, maybe more symptomatic of a strong labor market. We've got ADP private non-farm employment growth, and as they look at it on a trend line basis, I mean, This number by the ADP measures is slightly off a little bit, but it's still positive, and it's not anything that you would expect if you felt like you're heading into a major economic downturn. Here we have small businesses. This is employment by firm size. What's really notable here is that small businesses, even though maybe their optimism is improving quite a bit, you've seen kind of a flatlining in the aggregate employment levels, where you've really seen the boost. And I referred to the Challenger Gray data earlier that said that these layoffs are really kind of flattening out. Well, in fact, a lot of these larger firms with 500 more employees are really ramping up their workforce, and you can see with 50 to 499, that number has come up and continues to move forward while that small business number is flatlining. Now, there are read-throughs on this, so there is the feeling that you're getting more small business productivity, so they're not having to hire a lot of workers, but they are reporting in the optimism surveys that they're feeling better generally about things, and they're feeling better about their price situation. So that is a source of perhaps optimism amidst this kind of a data point right here. But as you can see in the private employment monthly change, we're getting a lot of traction out of health and construction, leisure, and hospitality. So I would submit to you that the three largest areas of growth overall last year in the labor market, where we had the most labor gains, was in education, health, leisure, and hospitality. And what's not really reported here is in government hiring at all levels. And those were the three big areas last year from the labor market perspective. But then, just over the last couple of months, we've seen greater traction out of retail, professional and business services, and IT to some degree, and also finance as well. Another look at payrolls as we look at it on a multi-year trend line basis, and this is average job growth per month, and this kind of puts a little bit into perspective kind of the transmission of policy into the labor market. It's hard to see in real time because it doesn't really feel like we've had a lot of change in the labor market. But 2022 we had 377,000 jobs, and if you go back to 2021 here, then in 2020 obviously was a year of immense disruption. That you're going to have a little bit of a bounce back, but you could see taking 2023 and kind of looking and drawing it forward to forecast for 2025, just a general slowdown in overall job growth. But again, it's exceeding the level that you would have to have just to kind of replace workers that are aging out and transitioning out of the workforce. So here we have a quick look at after-tax wages by household income. And so we've got three different basically terciles here. You've got the lower income cohort, which has grown a lot faster, over the last, call it 5 years, than the middle and the higher income cohorts have. And some of this has had to do with government stimulus and the stimulus checks that have been much more impactful at this level than it was at this level. But nevertheless, you can see that this has helped support consumption to a large degree, which continues to be strong. We talk about retail sales and whatnot, and a very interesting data point here. Look at manufacturing a little bit. Manufacturing was positive. Here we see taking out some of the more volatile components. We have X transportation. That number was positive. Overall, new orders, manufacturing new orders, including transportation, was adversely influenced by a drop in small aircraft. But again, normalizing for kind of what represents the kind of the rest of the manufacturing economy, that was positive. You can see here that heading out of the bounce back of the pandemic, we did have a contraction. We actually had a manufacturing recession to some degree, and you can see that we battled past that a little bit. Now we haven't reattained prior peaks, but manufacturing is trying to come out of its doldrums. Now we'll take a look at consumer credit. You can see here the last reading. We had a rather significant drop in the month of November, something that we haven't seen in quite a while. And you can see, a very prolonged period of increased revolving credit being taken on by consumers. Maybe become a little bit more choppy here over the last year or so. But this was definitely a surprise. It's very interesting that we have credit card interest rates that have gone up very dramatically. We're almost 23% on the average rate for credit cards. And when you think about the consumer, we've been talking about how strong they've been. Retail sales have been very positive. This is something that we do care about. So revolving credit balances moving up, lead to the potential for a credit problem at the consumer level. We have seen delinquencies pick up, but as we've shown you over the last several weeks in the charts of the week there, that these delinquencies haven't become problematic yet. But what's interesting here is that we've seen a rather dramatic, at least a one-time decline in the demand for credit, and it'll be very interesting to see if this is habit forming moving into the next month or so. So another thing we've been talking about has been stress at the company level, and we do see that bankruptcies have increased, versus 2023, and that number was up, rather significantly from 21, 22. About this time last year, I was spending a lot of time talking about bankruptcies because we hadn't quite gotten this data yet, but we were getting like year-to-date data was like here or here, and it was something that we wanted to watch. And so the fact that these bankruptcies have been on the rise, and this is data from S&P Global Market Intelligence, is something we should definitely take stock of. Now, on the flip side, I've shown you that that we've had a rather prolonged period of bankruptcies that maybe aren't quite at the levels that we've seen now, but they've been rather consistent. So what we don't really have a full sense on, with at least regard to 2024, is how this is broken down by various sectors. And you see a lot of small businesses that were created back in the pandemic. These small LLCs have filed, and you also, as you just saw earlier in the chart back, you've got more optimism in hiring from larger enterprises, and so really it's not coming from there. It's coming from small to medium-sized businesses that have faced perhaps increased stress. People that don't generate a lot of cash flow, but then have revolving debt or maybe at variable rates, and those rates have gone up. And so we do see a little bit more stress at the small to medium-sized business area, but it's not an area, or it's not at a level yet that it gives us a lot of pain. But it is something worth watching. This is one of the more interesting charts I've seen in a while, and I love kind of correlations back in history, and this just looking at it on its face, to kind of the current data point, it's eerily striking how much correlation there is in this. And so what this is the inflation numbers, and this amber line, it represents the inflation from November 2013 through the end of last year, and you can see how it has moved up and down. And the blue line actually represents consumer price index or inflation year over year, going back from starting from 1966 and going through 1982. And we know that the early 80s were marked by very pronounced the spike in inflation, where interest rates and mortgage rates and cost of everything went up dramatically. And so I'm not trying to draw a parallel that we're going to have a resurgence in inflation, but the narrative now is that we're going to get some kind of bump in inflation because there's an intent on the White House to impose very high tariffs on countries. And I think, again, the rhetoric is pretty strong out there. I think honestly, a lot of this is being used as negotiating tactics, and I do think that we're going to get increases in tariffs in some cases, which might result in a little bit slower growth rate than we were anticipating. It doesn't really tend to paint the picture of this because trade itself represents 10 to 15%, net trade represents 10 to 15% of our total economy. So I don't want to get too carried away, but I thought that this chart was very interesting in the sense that past, seems to have been prologue in this case, that this follows a very repeatable pattern, but not to get too carried away that we're going to have this major resurgence in inflation, and this is probably where we begin to see divergence in these two data series. All right, we'll talk about the break-even rate. So this represents inflation expectations moving higher. This is kind of the estimate for 10-year inflation has moved up to 2.42%. That was at 2.3% for a couple of months. Nothing to be overtly worried about, but this is just very symptomatic of overall interest rates moving higher, feeling like their interest rate regime is going to stay higher for longer because the economy is just flat too strong, and we're not going to get these rate cuts, and the risk of tariff-based inflation pressures or tariffs as a mechanism to help reduce the rate of disinflation, rather, is causing these overall expectations to move a little bit higher. Now we look at China briefly. China actually, from a stock market standpoint, had a reasonable year last year, but the economy remains in kind of a funk right here. And I thought these were two very interesting charts because back about 10 years ago, the expectation was that by the time we got to about 2023 or so, that China's economy was going to surpass the United States. Well, that got revised in 2019, and so that date got pushed out to like 2030. And then after the experience of the pandemic and the actual contraction and the way that China prosecuted its response to the pandemic and the prolonged lockdowns and the fumbled reopening and so on and so forth, that trajectory has been altered significantly. And so we don't really have a view or an expectation as to China actually surpassing the U.S. in terms of overall economic growth because of some of these problems. And then here we have working age population. We've talked about this before, but now you have that working age population that's actually in net decline. And so you have these very firm secular drivers for reduced overall growth for China. And I think this is going to play out in the investment world over the coming 5 to 10 years. Quick check-in on crude. This is NYMEX crude, and you can see that it's up against a moving average. This is a 200-day moving average. We have had a little bit of a pickup in crude, kind of testing its upper resistance level, but good to see crude higher. We do see with strong dollar that we've got some other members of the commodity basket that are participating in increases as well. Here we have global stock to bond ratio. So this is basically a worldwide look at the relative valuations. You can see here that this has picked up considerably. This is really a sign of global optimism as it relates to future growth. And when you have that kind of environment, that you tend to see better reaction out of stocks than you do bonds. And here's the global manufacturing PMI, Purchasing Manager Index, that continues to hold near the flat line. And we've had some green shoots of optimism there, but obviously that's not weighed down overall sentiment because you see that stock to bond ratio be very, very strong. So this is very representative of risk-taking, kind of a risk-on environment in the global marketplace, even though that we have kind of mixed growth across the globe. We just talked about China a little bit, but there's a pretty healthy optimism globally that we'll begin to see this traction happen in the coming year. Now, having said that, we do have very strong equity sentiment here domestically, and you can see the U.S. bullish sentiment amongst traders very, very high. In fact, levels that we haven't seen in a very long time. We have advisors that are bullish. We have consumer confidence that is kind of almost shot through the moon, and so I guess speaking for my own part here, and I have exhibited a lot of optimism to you in the recordings that I've done over the last couple of months, but I do lace it with a healthy dose of caveat that I think this is the trajectory upward in the ability to make money in stocks is it's not going to be as much of a straight line as it has been. And we need to be prepared for that. Now, I think if we look at last year, we had different levels of drawdown in the various markets, but from their peak, we saw drawdown in, like the Dow, the S&P, and certainly the Russell 2000 of 8 to 13% from the peaks. And so that feels very painful talking about that. And it didn't all happen in one day, but I think we should just be prepared for some increased volatility. Now, having gone, or let's slide over here to the right side, we've got forward EPS growth, and we've talked about this. It's upwards of 15%. And I do think that that's a little bit aggressive, and certainly coming into the year, typically what happens is that you have earnings estimates that are, tend to be low, and then they get moved or adjusted higher as you get into those respective quarterly earnings periods. And this year is a little odd that we're starting off around 15 or so percent. I think the way this is measuring it, probably adjusted earnings is a little bit closer to 12 to 13%. And honestly, if you told me that earnings are expected to grow, 5 to 8%, I would take that in a hot minute. But here we have the 10 to 2-year tips yield curve. So this is moving higher. You typically see, some measure of correlation here. And it's not a really strong correlation, but I do think that earnings estimates might be a little high coming into the year, and then that coupled with a lot of optimism here, kind of sets us up for a little bit of disappointment. And just like we saw last week with the labor data, oddly enough, labor market very strong, but it happened to be stronger than expected, and that was interpreted negatively from a stock standpoint because everyone was of this mindset that we're going to have the Fed reducing rates, and honestly, I think that there's a really strong case to be made that we don't have any rate cuts this year at all. All right, talking about small caps here, and we've got small caps as a percent of the total market. You can see that this has been in decline for a rather long time, and so small caps were all the rave. This is back in the mid 80s, but when we talk about the tech bubble, we had a lot of small caps that were just riding the coattails, and so that obviously changed during the tech bubble busting. But then they had a resurgence and they've gone back down, and we're at the lowest point that we've been at since probably I think the late 1920s, like 1928. So small caps as a percent of the total market, very, very below average right now. And it does present an interesting opportunity and a challenge. The opportunity is that the valuations are much more agreeable than large caps. However, small caps definitely do need a catalyst. All right, well, looking at the bond market, we've talked about this quite a bit. This OAS, and this might be like Greek to some of you, but let me kind of put this in English. So this is basically a high yield option adjusted spread divided by investment grade option adjusted spread. And that the spread that I'm talking about is the difference between the yield on these high yield and investment grade bonds versus the U.S. Treasury. But in this case, we're looking at it on a relative basis and just saying market is not pricing in a potential economic volatility at all. They're not pricing in really much of any stress in the market. And this goes back to that exuberance that we saw on the equity charts here, looking back a slide or two. And I think this is very interesting. And you see like flows into bank loans have been rather tremendous. And this tends to be a little bit more of a risky part of the market when you feel like the economy is slowing down. And I think the real thing to kind of get our arms around and watch as we head into probably the second quarter and the third quarter is, to the extent that these policy initiatives at the White House level are manifest into anything real here, right? I mean, we've got the risk of tariffs, which I think ultimately are a bigger risk to growth than they are to inflation. And then you've got the immigration policies, which could, impact the supply of labor. And I think that's important. I think if you're worried about inflation, I'd worry less about it coming from tariffs than I would from some type of really aggressive immigration policy that would constrict the supply of labor. So here we have treasuries, and this is just for historical context. We know rates have been going up, and we know for a very long time rates were moving down. So ever since like 1982, we've been in this massive secular bull market in rates where you could just you could buy a long-term bond and just basically write it down the maturity curve, and you get capital appreciation as well as the income from it. Well, that all changed, and now we're in an environment where rates are moving up, and we've seen certain years like 2022 where bonds and stocks both went down, and it really challenged that allocation assumption. So money managers, and we're certainly not immune to this. I mean, we have to think differently about what we allocate into and how we allocate and what type of downside risk protections that we're introducing in the portfolio to try to alleviate the risk of from areas of the market like bonds that traditionally don't exhibit a lot of volatility. And so, but this goes back to 1790, and B of A is very famous for this, and I love historical context. And you can see the average 10-year Treasury yield since 1790 has been about 4.75%, which is about where we are right now. But you can see that has ebbed and flowed quite a bit over time. We've had some very strong secular declines in interest rates, and also some rather notable rises. And this is one of those times, and I think we're going to normalize. I don't think that we see these rates again for quite a while. Okay, 10-year Treasury term premium. So we see those premiums moving higher. This is just, kind of emblematic of everything that we've been talking about. Rates moving up. The yield curve is now positively sloped and becoming more positively sloped as we go. Honestly, I think that's a healthy development. I never was very comfortable with the inverted yield curve. Although, having said that, we do have short-term rates that are certainly higher than some of these long-term rates, and might be sticky here. But overall, I think the term premium is getting back to kind of a level that I would feel much more comfortable. So money fund assets continue to rise. That is an interesting development. So amidst all of the equity growth over the last couple of years, that we really haven't seen a pronounced dent in this. So this is money that's generating from, call it like free cash from a lot of different sources at the personal level. It's just more income. And we do see investment ownership at the household level in the equity market at an all-time high. But there's still a lot of money out there that could potentially come off the market. This is all potential liquidity that I don't think all would like rotate into the equity market, but certainly some of it would. And This is a really stark development because we haven't seen a multi-year rise like this in any type of recent history. So now we look at the sensitivity to rates. And so what we have here is the 10-year Treasury yield sensitivity to inflation surprises. So again, if you think about, okay, well, what happens with tariffs and what happens with immigration policy, that treasuries are proving to have a very high sensitivity to that. If you feel like there's going to be more inflation, then these 10-year treasury yields are going to move higher, and that's going to result in less beneficial performance out of bonds unless you're staying in short-term floating rate uh, instruments like we are, and you can benefit from those rises. So interesting here that what this suggests is that if you feel like there's potential inflationary pressures of any degree on the horizon, then you would expect more bond market volatility. Conversely, you see equity market sensitivity to inflation has come down quite a bit, even though it remains elevated to historical standards. But if you think that inflation is coming as a result of, and rates are moving higher as a result of overall economic growth, then that's a good thing. But obviously, if it's due to hyperinflation, that's not as good. But equity market really not pricing in that right now. Here we have the yield curve, which I mentioned a couple slides ago. You can see that we are higher at the short end. We get out 1 year, and then we begin to see this upwardly sloping yield curve. And I'd say that there's quite a bit of noise here between the 20 and the 30 year. Again, you don't have nearly as much supply in those instruments, so this can jockey around a little bit. But I just say that the overall tenor of this is upward sloping, which is something that we haven't really seen. I mean, it wasn't too long ago that we saw these, these shorter term yields be significantly higher than the 10 year. And so it gives me a lot more comfort here looking out into the near term future. This is a chart showing the S&P 500 and the 20-year Treasury correlation. And so anytime you see stocks and bonds become positively correlated, as it has become a little bit now, like a 1.0 here would represent perfect correlation, and you're never going to see that. But anytime you see 30, 40, 50% correlation here, that just means that the prices of these two very important asset classes are moving in the same direction or moving in a similar direction. I'll put it that way. And this is something you don't want to see if you're really an advocate of diversification. So again, this argues to be nimble in fixed income, take advantage of higher rates, let the market kind of drive income and not seek a lot of capital appreciation out of your fixed income, but rather seek the higher rates of income that you can get and just let equities do what equities do. The credit market here, looking at the S&P 500 earnings yield. So again, this is like the inverse of price to earnings. This is earnings to price. And it really looks low relative to triple B bond yields. And so usually when you get below this zero line, that tends to indicate that stocks are a little bit overpriced relative to high yield bonds. And these aren't really high yield in the sense that they're junk. Anything that would be below triple B minus would be considered that. But this is kind of an average middle market bond rating at triple B. And again, this is just an indicator that would tend to suggest that stocks are a little overpriced. Here we have equity put call ratio. And so when puts are below calls, that means that there aren't as many people that are buying insurance against a potential drop in the market as they are trying to buy additional juice if the market continues to go up. So this is a sign of some fairly strong optimism in the market, and that has really continued for quite some time. Risk premium here is the forward earnings yield minus the 10-year Treasury yield. And so when you think about, we saw this term premium a few slides ago, that's really dropped through the floor. So a lot of complacency here in the market. Again, when you tend to have complacency and you tend to have everyone just like generally optimistic, that just leads to the risk of these negative surprises that hit you. And it's like, well, I didn't see that coming. And market doesn't really like that. And that's what precipitates into these kind of 2% movements. So I think there is a bias for things to continue because there's a lot of liquidity hitting the market. However, just like I said several times already, that I don't think that that's necessarily a straight line. Total assets in U.S. listed exchange traded funds. This is really notable in my opinion. I think it has some implications. Obviously, there's a lot of new product out there, a lot of innovation going on within the financial product space. But it's notable in the sense that this trajectory here. I mean, this is truly geometric, and the challenge here is you have a lot of these products in the market that are focused on indexes and they're focused on baskets of stocks. And so if you're trying to either as an index ETF emulate an index or trying to mimic some type of pattern with some enhancement, you're still having to go buy those issues and you still have to go in the market. So the more products we have, ironically, you have the more products that are chasing what is proving to be kind of a declining supply of equities in the market. And so I think you maybe run the risk, if you're not very good at selecting these ETFs, of running into products that have a lot of tracking error. Again, not all ETFs are made the same. There's some very, very good ones that you all have in your portfolios, but there's a lot of product that that may go away at some point. Even though you see this kind of like trajectory up here, in each of these years, there's a lot of ETFs that actually just go away. It's just the fact that they're being replaced by more new entrants is causing this to continue to be upward sloping. All right, so getting towards the end here, just a couple of interesting charts here, kind of an update on U.S. Crude production. Again, the U.S. continues to drive new sources of energy, and Russia remains stagnant. You've got countries in this list that are a little bit more challenged for capital spending. China is certainly not one of them, but Iran is, Brazil to some extent is, and Russia certainly is, and Saudi Arabia is, amidst it all, trying to control the rest of these players here to a large degree on the right, maybe excepting Canada, by manipulating their supply to help influence prices. But U.S. major player, exporter, really not talking crudes, but distillates and condensates and natural gas liquids here. Very, very strong energy production, which from an economic standpoint helps to drive more stability, helps to drive more national security, and interesting to kind of share that with you. Last slide here is a population growth chart. Again, I'm not waxing politics here, but it is an observation that it is a fact that we are a country that thrives on immigration. So anything that seeks to kind of reverse that trend, you can see here, for quite a few years, we had support from, basically net growth in the net organic growth in the population. This is just basically births minus deaths. And these blue sections here represent immigration. Well, immigration became a lot more, has become a lot more important here and is expected to really become significant in terms of its ability to generate overall population growth. And, if you get into, these out years, again, this is, a pretty broad forecast by the Congressional Budget Office, but if you have basically net growth, or you have like a contraction in the organic population, you're really going to need to have immigration take up the slack, and as you grow your overall population and as you grow your overall labor pool. So this is this type of conundrum where you don't have that immigration replacement is exactly where China is right now. And this leads to secular decline. It leads to lower overall growth and returns and everything that comes with it. So again, this is looking out on the horizon. So this 2034 would be essentially 10 years from now. And so policy transitions are going to be very important here on what the labor pool actually looks like. Well, I hope you found that interesting. That concludes Chart Pack of this week, and hope you have a great week, and we'll talk to you again soon. Take care. Bye.